I went from losing a lot of money in the best companies in America to making a lot of money safely and steadily in the bonds of some of the worst companies in America. So it helped me to two conclusions. It's not what you buy, it's what you pay. And good investing comes from buying things well, not from buying good things. And if you don't know the difference between buying good things and buying things well, then you're probably in the wrong business.
Hi, this is Weronika. Today we will talk about one of the most iconic investors, Howard Marks. We're going to break down his take on how setbacks lead to new opportunities and that good investing comes from buying things well, not from buying good things. Howard Marks is an investing legend and multi-billionaire who is the author of two best-selling books, The Most Important Thing and Mastering the Market Cycle. He's the co-founder and co-chairman of Oaktree Capital Management, which is a global investment giant. And since he's been writing memos to his clients for 35 years, it have made him one of the world's famous thinkers on investing for his insightful approach on financial markets. Warren Buffett once said that when he receives memos from Howard Marks in his mail, he can't wait to read them and he always learns something new. Let's listen to Howard Marks' 4 lessons on good investing. Howard Marks refers to his own experience of starting a convertible bond fund in 1978, which changed his life. He quickly understood that a safe and sound investment is not about what you buy, but what you pay.
You know, I'm a great believer in luck. I've been writing the memos to clients now for, I think this is the 34th year. And I wrote one, I believe it was January of 14, called Getting Lucky. And that one got the most responses of any until lately. And it was about how lucky I've been. I feel I've been inordinately lucky from the timing of my birth, to my position at the front of the baby boom, to the fact that I got into Wharton when they said I wouldn't, and so forth. But certainly, having started the convertible bond fund in May of 1978, I got the call in August that changed my life. It was from the head of the bond department. And he said, there's some guy named Milken or something out in California, and he deals in something called high yield bonds. Do you think you can figure out what that is? There have always been low grade bonds, but the way they came into existence prior to 77, 78 was that they were high grade bonds that got into trouble, so-called fallen angels. What Michael Milken, Drexel Burnham, and some others at the time did uniquely is they had this concept that you should be able to issue non-investment grade bonds if the interest rate is sufficient to offset the risk. Makes perfect sense. But prior to those days, it was impossible to issue a bond that wasn't investment grade. Moody's, in its manual, defined a B-rated bond as follows: fails to possess the characteristics of a desirable investment. In other words, it was bad. And that was without reference to price. And this was, if you think about it, the ideal bookend to my experience in the 70s. I went from losing a lot of money in the best companies in America to making a lot of money safely and steadily in the bonds of some of the worst companies in America. So it helped me to two conclusions. It's not what you buy, it's what you pay. And good investing comes from buying things well, not from buying good things. And if you don't know the difference between buying good things and buying things well, then you're probably in the wrong business.
He states that the world's most successful investors keep their emotions restrained and they go counter to the trends that the majority of investors follow.
Emotion is the greatest enemy of superior investing. If you take a look at most people in what they call the herd or the consensus, as the economy does well, as the company's profits grow, as it reports higher earnings, as the stock rises, most people become more and more and more excited about it, more optimistic, more trusting, and they and more inclined to buy. So the higher the price, the more buying they do. Then eventually things stop going so well, the economy turns down, the corporation's profits contract, the earnings announcements are negative, the price of the stock declines, people get pessimistic and depressed and more likely to sell. So the higher the price, the more likely they are to buy. The lower the price, the more likely they are to sell. This is the opposite of what we should be doing. We should be scaling out as the price rises, perhaps when it gets unreasonable, and we should be getting in with both feet when it falls. So clearly, most human emotion is arrayed against doing the right thing. And, there are a lot of other examples, not just that, but, there's a reason why Buffett said the less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs. When other people are unafraid, we should be terrified, because that means they'll pay prices that are too high. When other people are terrified, we should turn aggressive, because their terror makes things available to us cheaply. And you're right. I mean, the great investors I know are unemotional about their investing, and they go counter to these trends.
The biggest challenge to taking control of your personal finances, improving your investment returns, and building a better future is just getting started. This means getting organized, having a plan, and being disciplined. As Mark Twain once said, the secret to getting ahead is getting started. To break out the treadmill of slaving away each week only to have nothing left over, watching the savings you do have to get eroded away by inflation's vicious bite, or freeing yourself from the corporate grind requires that you master the conversion of time into value. To help you do this, we created a list of 4 simple steps to take control of your personal finances and life. You can download it for free by clicking the link in today's description. Howard Marks started his first summer job at First City National Bank in 1968. He became an equity analyst the next year and then director of research soon after that. He recollects his memories of how he lost his seemingly dream job in a corporate organization where he'd go from having 75 subordinates, a $5 million budget, membership of the investment groups, and most important committees, to having no subordinates, no budget, no committees, and yet he'd find it exciting, inspirational, and better for his career trajectory. What we can learn from Mark's story is that expanding your expertise in depth within a specific field can be much more valuable, rewarding, and exciting rather than touching on the surface of multiple areas without a deeper dive and understanding.
I'm not sure I recognized at the time how bad the firestorm was. I thought I was doing okay. It's just the Nifty 50 stocks that were having a terrible time. But yes, if, as you say, I joined the investment research department for the summer at First National City Bank, which later morphed into what they now call Citi. I believe it was maybe the world's largest financial institution at the time, riding high, as were the Nifty 50 stocks that most of the money center banks, we had this expression, money center banks, the ones in Boston and Chicago and New York, et cetera. And most of the money center banks subscribed to this thing called Nifty 50 investing in the 50. It wasn't strictly 50, but in the best and fastest growing companies in America, companies that were so great that nothing bad could ever happen. And because they were growing so fast and of such high quality, the official dictum was that there was no such thing as a price too high. And importantly, no price too high. Those 4 words, I think, are the hallmark of a bubble. And we hear it said every time something's in a bubble. So looking back, I had my first brush with a bubble. And if you bought the stocks the day I reported to work and held them for 5 years, you lost almost all your money. Why? Number one, they were too high. And many of them carried PE ratios between 70 and 90. And 5 years later, between 7 and 9. So there's 90% off the top right there. But secondly, these companies that were so great, nothing bad could ever happen, a lot of them turned out to have feet of clay. And, where's Polaroid? Where's Kodak? Whatever happened to Simplicity Pattern? Who do you know that makes their own clothes these days? So, it shows you the undying devotion to a concept, which became a bubble, which became a crash. The overall investment results at Citibank were so bad that in 1975, they brought in, 77, they brought in a new chief investment officer, Peter Vermillier, and we hit it off well, but he wanted to have his own director of research. And I helped him land a guy named Charlie Porton for that job. And then he says to me, well, what do you want to do next? In retrospect, I think I was lucky not to get fired, but of course, in those days, corporate America pretty much involved lifetime employment. So I said, I'll do anything except spend the rest of my life choosing between Merck and Lilly. There are, I believe, more and less efficient markets. And the market for the great US big stocks is among the most efficient markets. And I think that to spend your life choosing among them is mostly a waste of time. And we know that most people who manage money in the biggest stocks, most of them don't do as well as the index. So that was a good decision on my part. Vermillier, who had come from JP Morgan, said that where they had a very successful convertible bond fund, he said, I want you to join the bond department and start a convertible bond fund, which I did in May of 1978. It's interesting. I went from 75 subordinates, a $5 million budget in a time when that was a lot of money, and membership on all 5 of the investment group's most important committees, to no staff, no budget, no committees, and I was ecstatic. As director of research, my job was to know 2 sentences on 400 companies. Now I only had to know everything about a few companies. And I was, rather than competing in the big stocks where everybody knows everything, I was competing in a small backwater that very few people were concerned with. And the scope for superior performance was much greater, and the intellectual excitement of knowing a few things in depth was terrific. And that really put my career, my life on a great upward trajectory.
Marx also shares what is the secret to good and lifelong partnership, both in business and life, based on his own experience and what proved to work for him. He sheds light on how valuable it is to cooperate with someone who can have different skills than you, but the skills should complement each other. So not only the result of working together is successful, but also the whole process of working together is.
And I said the secret to good partnerships is shared values and complementary skills. And a chicken shouldn't work with a pig. A buccaneer shouldn't work with a clergyman. Can you imagine if you had a partner in your business whose view of ethics was different from yours? But Bruce and I share to the extreme the desire to operate on the high road. We're very different people with very different skills. I always, Kahneman's book, Thinking Fast and Slow. I'm a fast thinker. I give my reaction to things often intuitive and intestinal. And Bruce is a slow thinker, and he thinks things over. He reaches a conclusion, then he thinks them again, then he thinks them again. And the combination of the two has been incredibly successful. But the key is I don't disrespect him for dragging out his considerations, and he doesn't disrespect me for being intuitive. And that's incredible formulation for a good partnership.
That's it for today. Remember to subscribe to our daily newsletter, We Study Markets, by clicking on the first link in the description below, and subscribe to our channel too. Thank you for watching.
He told Lilu and me that he wanted us to get together for lunch once a month. He basically pretty much instructed us that the two of you, I want the two of you to meet once a month for lunch.